So there's a lot of conversation going on about whether or not if the person who owns the property or a real estate investor should pay off their property early. Okay, let's get into it, ladies and gentlemen. Now, again, keep in mind that I've been in financial services for 36 years. I've interviewed over 3,000 persons. I have probably, I don't know how many books and courses and continuing education I've had to do. But I think I'm more than qualified to speak on this, including the fact that I've been a part of processing indirectly over 500 mortgages. So I think that I can speak to this. So let me just share a quick story. So about 20 years ago, I was introduced to a book by a gentleman named Rick Elman from one of my mentors, right? So the mentor says, Liz, take a look at this book and let me know what your thoughts are. And so I did that. And as I began to read this book, it talked about why you should carry a big, long mortgage and never pay it off. And so I said, well, this is contrarian to, what we're typically taught. And so I shared it with a couple of clients, and they said, well, you know what, that makes sense, Jeff. I spoke with another client. They said the same thing, talked with another client. And little did I know in this little test group, if you will, the whole idea of paying off the mortgage was early, that was open for discussion. And that as we looked at the facts regarding this conversation, it just made sense to carry a big, long mortgage and never pay it off. Let's talk about the reason why people pay off their mortgages and the issue regarding whether or not if you should or should not pay off a mortgage early. Well, keep in mind, first of all, that when we're talking about paying off a mortgage early, that creates a cost within itself. Why? Because remember, every single payment that is made, every single mortgage payment that is made, that money is paid typically through cash flow. Either a person worked for it or they got the money from some other resource and they're now paying that mortgage. Well, the problem with this idea is that every time a mortgage is paid, every time a debt is paid, that is called, in my opinion, a negative wealth transfer. Why? Because I am giving money or transferring money. Let me be more specific. I am transferring money from myself to who? To the lender. In exchange for what? In exchange for continue to stay in that property, right? Or to continue to own that property. Well, this within itself is an expensive financial transaction, because when we sign a mortgage, what we're really doing is we are literally forfeiting future money in exchange for signing this mortgage or for agreeing to pay for a mortgage. So we're going to give up our future in exchange for paying off that property. Okay, so within that within itself, you say, well, if you're a real estate investor, you may be thinking, well, I'll just have a tenant pay it for me. That's true. But keep in mind, you're still transferring a cash flow deposit away from yourself. You are literally creating a negative wealth transfer. That is not eliminated just because you have a tenant who's making the payments on it. It is still a negative cash flow against yourself. The second piece of it is that when a mortgage payment is made, who is that mortgage payment made to? To a lender, right? What do? Do they just take the money and sit on it and just, look at it every day? No. They take that money and they reinvest it. Why? Because they want to create compounding on that money, and they have a long-term agenda. Their overall objective is to double those cash reserves over and over and over and over again. The power behind this type of compounding is that they're getting the money from the payer of the mortgage. Isn't that interesting? That the very seed for this type of compounding is coming from somebody else. Ooh, you can't tell me that the bank is not brilliant-minded. You cannot tell me that the bank is not smart, because they are creating wealth from other people's money. So this whole idea of paying off your mortgage quicker, keep in mind, you're only making the lender richer faster. And you're working against yourself because, again, you're not creating compounding on that money. Just those two economic facts is working against the person who is paying the mortgage. It's working against them because they're losing control of the wealth. It's working against them because they are literally transferring the flow of cash away from themselves. And then the compounding, the wealth that is being created from the payments itself, the debtor is not participating in that profit. Ooh, goodness gracious. So the whole idea of paying off the mortgage faster, it may not be as smart as people think it is when we look at it from this perspective. One of the things that I've seen is when a person is making extra payments on their mortgage, a real estate investor is making extra payments on that mortgage, they feel as though that they're getting ahead until when? When they have a crisis, when they have an unexpected expense, when things go wrong and they need cash reserves, or they want to get their next property and they're coming up a little short, or an expense came up and now they have to go get a loan to fund the expense. All of these are telltale issues of what happens when we are accelerating cash flow away from ourselves, because when something comes up, we either don't have the money or we have literally transferred wealth away from ourselves and we can't take advantage of an opportunity because we have transferred away that wealth. Okay, so when we look at the whole ideal of paying off the property quicker, we need to understand the numbers behind it. We need to understand the consequences that it creates. We need to understand the expense behind it. We need to understand the fact that you are literally transferring wealth away from yourself, and that you actually may be creating more problems than you are actually solving, because paying extra on the mortgage is expensive. It is some of the most expensive money that you're ever going to transfer away from yourself, and it works against you. The question is going to be what consequences or what circumstances are going to come up where you're going to need that money or wish you had that money. And if you're looking at it from a long-term perspective, over a 5-year period, a 10-year period, 15-year period, 20-year period, those extra dollars and the compounding of that money is very, very expensive, and it works against the debtor. Ladies and gentlemen, paying off the property may make sense, but it may end up costing you a fortune and causing you to sacrifice or forfeit future opportunities, as well as put yourself in a financial jam because of an unexpected crisis or something that came up. Maybe you're taking care of a loved one, or any other type of situation where you need that money, but 5 years, 10 years ago, you accelerated the payment of your mortgage, and that money is gone forever. So, should you pay off your mortgage quicker, or is paying off the mortgage really the issue at all? Is debt, we're going right back to this whole point, is debt the issue at all? I'm going to say that debt is not the issue. The real problem that we have is what? Is the transfer of wealth or the transfer of cash flow, the fact that we lose control of the money, and the fact that we're forfeiting future profit from the money. So wait a minute. If those are the real issues, then why aren't we reverse engineering the real problems and then focusing on solving our debt problem by reverse engineering the flow of cash, reverse engineering the loss of control of cash, and reverse engineering the compounding that we are forfeiting? Ladies and gentlemen, I said it once, I'll say it again. If debt is the problem, why are banks making massive profits from the compounding of the payments on that mortgage? If that is the problem, I don't think that is the problem. I just think that the debtor is thinking like the debtor, and as a consequence of that, it is costing them a fortune because they do not understand the power of cash flow and the compounding of debt payments and the control of cash reserves. Once we reverse engineer those three things, then we can solve the debt problem simply by being as smart as the bank. The bank is not the problem, ladies and gentlemen. The bank is the teacher. And when we can implement the same strategies, if we can reverse engineer the same strategies that the bank is utilizing for themselves, I think we will find that not only do we solve our debt problems for once and for all, that we have the accumulation of cash reserves, we have interest from those cash reserves, cash flow, profit, and then velocity of money. Those are the things that we should be aiming for, not necessarily the accelerating the payoff of debt for whatever reasons that the person may be considering those. Now, like anything else, you have to know your numbers and your situation. But the point being made is that even if you've got a good reason to accelerate the payoff of debt, you do not eliminate the fact that you are transferring wealth away from yourself, that you're compromising the control of money, and you're not participating. You're literally forfeiting the future profit that is being created from those payments. So let's get into it, ladies and gentlemen. If you think that this is a good idea, or if this makes sense to you, order the free report associated with this video. Let's talk a little bit further on how do we reverse engineer our debt versus accelerating the payment of the debt to solve the debt problem. Woo, goodness gracious, this is good stuff. I'm looking forward to seeing you soon. I hope you've registered for our next seminar where we're talking about how do we reverse engineer our debt rather than overpaying for our debt to accelerate the payoff of it. All right, have a great day, guys. I'll see you sooner than later. Bye-bye.